Welcome to this short video about how managers and entrepreneurs can use accounting information to help answer some of the questions they might have about a business. The questions we're looking at here are these two. Did we make more or less profit than we should have done? What could we have done to make more profit? So, dealing with the first one first. Did we make more or less than we should have done? So you use the budget. You take the budget figures and you compare them with what actually happened. And the difference between the two is called a variance. And if that variance increases the profit, we call it a favourable variance. And if it reduces the profit, we call an adverse variance. And this business of looking at these differences and doing something about them is known as budgetary control. So here's an example of that. Kirkstall Limited, the budget figures on the left, the actual figures in the middle, and the variances on the right. Looking at the bottom there, we can see that profit is up. So that's good. Although just looking down the column on the right, we can see there's a large adverse variance on rent. So that might be a problem. And also the variance on unit level costs is also slightly worrying. But sales were up by 10%. Okay, they went from 200,000 to 220,000 units. So, if they're up by 10%, you've expected revenue to go up to £660,000. But it didn't. It went up to £655,000. And you'd have expected unit costs to go up 10% to 264 from 240, and they went up to 260. So things haven't quite happened as you expected. Now these are the unit level costs, the revenues and the unit level costs. For the non-unit level costs, we would need a bit more information. So we've been to Kirkstall and asked them, and they have said that the situation is that if their output exceeds 210,000 units, they need to rent extra space. But the other unit level costs won't change. Now the actual output was 220,000 units, so the rent will go from 100,000 to 130,000, but the others will stay where they were, which was £50,000. So here is a revised version. Here is what we would have expected if we had known we were going to sell £220,000. So the revenue's gone up, the unit level costs have gone up, the rent's gone up, the other costs have stayed the same. Now we call this a flexed budget, whereas the other one we call a fixed budget. Notice that the profit here is actually less than it should have been. And the biggest problem isn't the rent. The rent isn't a problem at all. Now, the biggest problem is actually with the revenue. Not the number of units, it must be to do with how much they're selling each unit for. Right, moving on to the second question, what could we have done to make more profit? What you want to do there is find the causes of variances, especially the adverse variances, and come up with some corrective action to deal with it, or to stop the problem happening in future. So going back to this one, what's happened is the revenue is adverse, so that's probably a price reduction, but that might have been done in order to sell more units, so that there could be a connection there. The unit level costs are favourable, so maybe that was because we were buying slightly more volume, whatever, we're not going to worry about that too much. And the other non-unit level costs have gone up a bit, maybe they had a few extra administrative staff or sort of warehouse people or something to cope with the extra demand. So those are the possible reasons. The main problem is the revenue down because of the price cut. Now, maybe we should increase the price and get back to 200,000 units. The danger is, however, having made the price cut, when you put it back up again, you may not return to 200,000 units. You may fall lower than that. But that's what management is all about. Okay, just to recap, so you have fixed budgets where the actual results are compared with the original budget, only really suitable for stable businesses. And then you have flex budgets where you revise the budget figures to reflect changes in the original budget assumptions. And when you do that, your variances will then reflect genuine problems and opportunities. Okay, I hope you found this video useful. Further details can be found in the book by Ralph Whitaker. Thank you.